I love covering chapter 16, which is about financial and securities markets. As a nice follow-up to the Federal Reserve, chapter 16 looks at the stock market and bonds and debt, not from the standpoint of you as an investor looking to buy stocks and get rich quick, but more from the standpoint of a business seeking to raise capital to fund its business activities. That is usually done by a person called a financial manager within a company. It's a well-compensated position, and I'll show you some of the job information for San Diego in a few slides. It's an ever demanding position within a company because businesses run on capital and they constantly have money needs. The picture in the upper right, Chris Gardner, famous success story in the financial markets as a person of color in a non-diverse business sector. Chris Gardner is now worth $70 million. He's an international speaker and wrote the book, The Pursuit of Happiness, which obviously turned into a movie portrayed by Will Smith. And that's, of course, entertainment. It's on a real story, real man. The reality, diversity in this particular business sector is quite dismal. Question in the bottom left there about percent of hedge funds do you think are owned, managed by women or minorities? It's under 2%. You can see in the bottom right there is a graph of some of the wealthiest hedge fund managers. Yes, the vertical axis is billions. And part of the reason hedge fund managers are so wealthy is because the capital gains tax rate is much lower than the income tax rate. Your learning objectives here. Next up, we want to look at the career of being a financial manager and how they're compensated. Financial managers get paid well. You can see an average salary just under $100,000. Projected growth rate over 21%. That's here in North San Diego County. You can see the skills that they're looking at for the bottom here in the tables. You see some of the companies that are looking for financial managers, hiring. You see a lot of defense contractors, but also hotel and tourism. So as I said, financial managers, their job is to find the best sources and uses of capital. What's the most efficient and least expensive, if you will, way to fund the business's need for capital. As I said earlier, when we were talking about the accounting chapter, cash flow is a constant challenge for businesses. So there's money going out and money going in, and is not always equal on both sides. There'll be time when maybe more money's coming in than is going out, and that's obviously good, and that results in profits. And there's other times where more money might be going out. Case in point, COVID-19 and the myriad of businesses that are pivoting and have to re-engineer their businesses to survive. So they are certainly facing cash flow problems, and financial managers are front and center in figuring out how to keep these businesses running. Do we have to lay off people? Do we have to take on more debt? So the money in, money out piece and cash flow is real. The main thing I want you to understand out of chapter 16, and that link you see there for the study guide, you can go to the Google Slides version of this lecture to find that there. And it's also in the Start Here menu. But I want you to understand debt financing versus equity financing. That's the main piece. This slide provides a nice tidy overview of debt versus equity financing. So again, this is a business seeking capital to fund their operations. If you're taking on debt, the advantage of taking on debt is that you don't have to give away any percent of your business, but you do owe people money. So when you have debt, you're just borrowing from a bank or some other lender, but that bank or lender doesn't have any involvement in your business. All they care about is that you pay your loan. When you get financing, capital, raising money through equity, equity is most commonly selling shares of your company. To do that, you have to be set up as a C Corp or an S Corp so that you can actually sell shares of your company. And when you do that, people are taking a percent ownership in your business. And there's classic examples of like Steve Jobs, who founded Apple, and he ended up getting voted out by the board And the company that he founded, he no longer had control over because he didn't have a majority share of the equity of the ownership of the company anymore. But the great thing about equity financing, as you can see in the bottom right cell there, you don't have to pay anybody back. So I'd like you to go to the Google Slides version here and look at some of these links. On the left there, you see trade credit and secured loans. These are short-term debt funding. So trade credit is where actually your suppliers are lending you inventory and you got to pay them back. But factoring in the bottom there is you can sell your accounts receivable. In other words, people who haven't paid, you can sell that amount owed, accounts receivable, to a factoring company. Those are debt collectors, and you will get a percentage of the amount that is owed to you. So maybe you have a total of $100,000 in accounts receivable, and you sell that to a factoring company, and they give you $50,000, and then anything they can collect on top of that, they get a key. So that's debt. And then long-term debt, typically things, mortgages or bonds. You can issue corporate bonds, 10 up to 30 years. You have a legal obligation to repay these. Next up, we want to talk about equities, which is selling a percent of ownership of your company. And the starting point for a company to do this is called an initial public offering, an IPO. That stands for initial public offering. An initial public offering is when the first time you take your business and sell shares on the stock market. That's an initial public offering. There's a lot of steps that a business has to go through before they can do an initial public offering. First off, a separate entity, an investment bank, has to determine how much the company is worth. And this is literally a snapshot in time of the market value of the company. It's their sales, their cash, their equipment, their patents. Come up with a market value. The company is worth X. But the company is obviously hoping that that valuation is high, and the investment banks maybe want it to be a little bit lower because they're looking to make some profit on the. But at any rate, that company is valued. On the right there, I have the example of Uber. You can use the Google slide versions to click on these links and see what was Uber valued at when it IPO'd back in 2018. And then once the people that actually they're selling the shares of the company to, the founders of the company get a percentage, hopefully a majority percentage above 51%, so they can maintain control of the company. And then the other 49% is sold off to institutional investors. That would be banks and insurance companies and pension funds and even some wealthy individual investors like Warren Buffett. Basically chop up the company and parcel out the shares, and the company gets a massive infusion of cash. However, they're now a public company. And when you're a public company like a C corporation or even an S corporation, you have to do a lot of reporting with the SEC, the Securities and Exchange Commission. So there's several pros and cons of being a public company. Having to report, the reporting requirements to be public is one. Now, if you decide to go on the Morningstar or E-Trade or some electronic investment site and buy some shares of Uber, and they went public back in 2018, and you want to buy some shares of Uber, that's not part of the IPO. That IPO is really kind of like the inside club of who's going to get invested in this company, and you have to have millions and millions of dollars to be able to buy into those shares of the company. Afterwards, once they're publicly traded on the New York Stock Exchange or the NASDAQ, yes, you and I, as average Joes, can go and buy shares of that company. That's called the secondary. It's kind of like the first time a house is built. if you bought a brand new house, you would be buying that house from the home builder. That's like the initial public offering for a company. But afterwards, say you live in that house for 5 years, you fix it up a bunch more, property value goes up, you sell it to somebody else. That home builder doesn't see any of that cash. They already made their cash the first time they sold the house. That's what an IPO is. That's the first time they release the value of the company, and there's a snapshot and a big chunk of money goes in, and certain investors now have a say in the company. But folks who buy shares thereafter, that's the secondary market. The company doesn't see any of those secondary market transactions. And I'm going to stop here. There's some additional slides if you want some additional information regarding the securities markets. But remember that businesses constantly have to evaluate, should I take on debt? If I want to maintain control of the company, I'm going to issue debt, and if I can make those payments. But the stock market is looking hot, and I have a favorable company, and I can get a high valuation for my company, and I don't plan on owning this company for a long time, then maybe I'm just going to do an initial public offering and sell shares and get the money that way. So it's different depending upon the company's needs. That's it on securities markets. Please check the study guide for study terms.